Thank you, everyone who's joined us here today. Welcome. This is another session that we're doing with our MAGNiTT series. Today's discussion is demystifying private credit. My name is Philip Bahashi. I'm the founder of MAGNiTT, a venture capital data platform that is now beginning to cover private capital across emerging markets. And in our continued attempt to kind of focus on the private capital space, I'm excited to have a conversation today around the world of private credit. And to do that, I have the pleasure of hosting Nathan Kwon, who's the principal at Shorooq Partners, who spearheads the private credit practice and is the lead manager of the new MENA fund, which is MENA's first tech-focused credit fund. Before jumping into the conversation, I think it's a very interesting time right now where private credit and venture debt are becoming increasingly significant here in the MENA region and across the emerging venture markets that we cover of Africa, the Middle East, and Southeast Asia. According to our data, venture debt, which we just published a report on last week, experienced 4 consecutive years of growth, with venture debt lending to equity financing ratios being at 1.4% in 2020 and now at about 28%. And I think it's because of that that this is an extremely pertinent time to be discussing what is private credit, because in the conversations I have with founders, investors, government officials, I think it's a little bit of misunderstanding of the different type of private credit tools and solutions that exist. And I think it's extremely important to be able to do that now against the backdrop of what is a very high interest rate environment. So it's interesting to see the implications and the challenges that come from that. But before I get into all of those type of details, I'd like to introduce and thank Nathan for joining me today, and also maybe to learn a little bit more about your experience. So Nathan, thank you very much for joining us on this conversation.
Thanks, Philip. Great to be here.
Very simple question. Nathan, you're in Korea. You came out to the region.
Okay.
What were you doing before you came out here, and what kind of brought you to the region?
Philip, I'd love to say that I saw kind of the Middle East rise all those years ago, was very prescient, had all of it laid out, and this was a very specific planned move. It actually really wasn't. And I think what brought me to the region were the people and the team that I'm working with here at Shorooq now. So 3 years ago, I was in Korea. I was working for a large asset manager there, and I had the pleasure of meeting Shane, who's one of the co-founding partners of Shorooq Partners. So at the time, I really didn't have an intention of moving. It was to just kind of get to know him, hear his thoughts. But man, this guy's vision and passion he had for Shorooq and the Middle East as a region really turned me. So after that one coffee, I decided to move my life over. A bit of a rash decision,
Nice.
perhaps, but I think it's worked out quite well.
Knowing Shane, he can be extremely effusive and very passionate, so I can completely understand that. You talked about being at an asset management company in Korea. I mean, what were you focused on then? What was the landscape like, and how many years were you doing that before coming out to the region?
Yeah, so that actually also ties into my foray into venture debt as an asset class. So I was working for Hanwha Asset Management, which is a large asset management firm, 80 billion AUM. It's part of the larger Hanwha Group, which is one of the conglomerates in Korea. They're big on solar, defense, insurance, finance. Now, I was working for the VC team, and one of the projects I took on for them at the time was setting up one of the first venture debt funds in Southeast Asia. So this was when venture debt as an asset class was first making its way out of the US. So in the US, venture debt's been around for quite a while, really since the 1980s. But then the rest of the world started adopting it more recently. India and China were the first ones to adopt it in Asia, and then Southeast Asia. And that was around the time I was there. So that was kind of my foray into the asset class. And then when I came to the Middle East 3 years ago and joined Shorooq, we kind of did a market research with the partners, see the lay of the land, and we saw that there was a huge gap when it comes to credit in the region. So given kind of my own expertise and experience and Shorooq's insights into the ecosystem, we decided to put those two together.
And just out of interest, I mean, based out of Korea, you were covering, because obviously we're looking at the emerging venture markets and we consider everything in Southeast Asia. We don't actually cover Korea. When you're operating out of Korea, were you looking at Southeast Asia as a market, or was it very much domestic investment?
So it depends on the funds and the strategy, but as a firm and as a practice, Southeast Asia was definitely part of our scope. And the reason is first of all, it's just geographically closer. So there's a lot more trade, even if not necessarily restricted to the tech ecosystem. There's generally a lot of imports and exports between Korea and Southeast Asian countries. A lot of the corporates, especially the larger ones, have offices there, they have teams that are working there. So we have more visibility into what's going on, what are the trends, how is the pulse beating in the ground. And finally, there's, of course, that cultural affinity, right? So, of course, it's not the same. But when it comes to kind of, let's say, lifestyles, food, culture, philosophy, a lot of it is something that we share, which also helps identifying the right problems and building the solutions to them, which is what startups do.
And interestingly, did you ever do venture capital investment yourself, or did you purely focus on debt and credit as a solution before moving to the region?
No, so I actually started out as a VC as well, true and tried. And then venture debt came along. I thought it was an interesting and a new kind of a challenge to take on. I really kind of saw the power of the asset class and what it could provide to founders and startups who are looking for capital to grow that is non-dilutive, that is scalable. And then since then, I think I jumped head in.
Any particular deals that you can speak of that you were doing in Asia before coming here that kind of really inspired you that this is an opportunity that's not currently being tapped into that you can speak to?
Certainly. So I think I actually mostly cover deals on the international scale more than Korea itself. But one deal from Korea, I think that stands out was something that we did. It was a securitization of music IP rights. And I think we're actually seeing something similar in Europe as well. The idea being that music rights yield a regular income, right? Every time it's streamed, played on shows, played on radios. Is there a way for the artists and the composers to actually turn that into a steady stream of income and get some capital by offering that right and partial rights on the public market to the retail investors? So this was a company that kind of put that platform together, started offering these music streaming rights to retail investors. It's a very interesting deal, not only from a tech perspective, but also on just how anything really could be turned into an asset and securitized, which I think is something that we're seeing across the board in these days, especially with the rise of the cryptos and the tokens as well.
Okay, let's get into the crux of the conversation. And just before we did that, you just mentioned now that when you joined Shorooq, and remind me, you joined maybe 2 years ago. So you've raised the fund now, but you actually 3 years ago.
3 years ago.
And you said you did some market studying on venture debt and on private credit. What were some of the key takeaways from that beyond the fact that you've now launched a fund? What was it that kind of sparked you as potentially interesting for private credit here in the region?
So back then, I think it's safe to say that really private credit for tech companies did not exist. So of course, the region's not new to private credit, especially when you go to the larger ends of the corporate world, where the blue chip companies and you have your ADNOCs and Aramco's, Emirates Steel. Credit, of course, has been available, but banks here do tend to be quite conservative. They usually require minimum 3 years of audit statements before you can even start the application or conversation for a loan. So given that the MENA's venture ecosystem really started in 2013, there hasn't been a mature enough generation of companies. There's always outliers, but as a generation, there just hasn't been a mature enough generation where credit could be offered en masse on an institutional scale. So that, from a statistical perspective, from a data perspective, it was actually difficult because there weren't any historical track records. But in a way, almost the absence and the lack of the data itself signaled, there's a huge gap here, there's a white space here. And then there's, of course, kind of the qualitative aspects we looked at it, right? The nature of the banks and how they look at loans and how they look at the practice of lending here was one. The other, I think, was, of course, the Islamic financing. So if you're doing lending and credit here, again, depends on the entities who are involved, but likely you'll have to abide by the Sharia principles and structure it in such a way that abides by the principles of Islamic financing. So I think that was another hurdle that kind of prevented from more global players from coming into the region. And I think the third aspect was, of course, beyond credit as an asset class, like how are we seeing the region's ecosystem, the tech ecosystem growing overall? And I think more than anything, that was kind of the fundamental thesis and the conviction that we first had to have, right? Will the region's ecosystem grow? Will there be a diversified need and demand for capital that goes beyond these early stage VC checks? And in all those aspects, we were able to tick the box.
Before deep diving into all of those products, we looked at private capital, as I mentioned, and it's amazing. We take 1,000-step view, and we had a quick conversation offline about this. So there's public markets, and obviously that's all on the stock markets that exist globally and anything that's in the public domain to be able to invest in. Then you come into the area of private capital. And when you look at private capital, you can take a McKinsey report, a BCG report, Bain report, PitchBook, Preqin. There's many different types of things. You see that it's segmented into different areas, whether it's private equity that we now started to cover, and we kind of deep dived into how private equity is different to venture capital and growth equity. You have the other extreme, which becomes infrastructure and real estate and natural resources. And then the bit in the middle is private credit. How do you define private credit? And the second part of the question is, people then refer to it as private debt. Is there a difference? Is it nomenclature? If we're demystifying this, what are the right terms to be using for private credit or debt as an asset class?
No, it's an excellent question, Philip. And I don't think there's one straight answer, but let me do my best to kind of try to put some bookends around it. Now, because I think the key word over the last decade or so has been convergence, we're seeing a lot of asset classes kind of blend in. You see the appearance of a lot of these hybrid instruments. So there's no clear-cut boundaries. But to start with the very obvious, I think the aspect is the fact that private capital or private credit is private, right? It's not, there's no centralized exchange where you could go and buy or trade it. It is done on a closed transaction with designated parties who you know before going into the deal, like who you're dealing with, who your borrower is, who your lender is it going to be syndicated? Are there going to be any agents or middlemen that's kind of running and doing the administrative work in the middle? It's, you know, the people who are involved, which allows you the ability to kind of go deep into both from the commercial aspects and also the personal relationship from the reference perspective. I think between private credit and debt, there's really no difference. Those two words are interchangeable. Really, yes, it's any kind of a fixed income product that is traded and transacted on a private fashion in a closed-ended deal. Doesn't involve a public exchange, I think classified under this term.
So we've shared an article on what we've defined, and what we found quite interesting is you got to look at it as an umbrella, as you correctly said, right? So it's private credit, private debt, interchangeable, but private credit could be a line of credit. So it's a specific product that could fall under this. Venture debt, which we've mentioned at the beginning of the webinar and we're discussing in the report that we published, is one other instrument of private credit. You mentioned just now that there were others, whether it was Sharia, Islamic financing. What are the other types of products that might fall into private credit that we're not really familiar with?
Right. So I think the largest portion of that pie is corporate direct lending. So it's where a lender just goes to a company, a corporation, gives a straight loan based on the balance sheet, the business of the company, the cash flows. I think that's the most vanilla form. And then within that, depending on what sort of a structure you attach to it and at what point in the capital stack you sit, you can get into senior, you can get into mezz, depending on kind of the asset that is underwriting the loan. You could have securitized deals. About a decade ago, these sort of mortgage-backed securities or mortgage-backed loans, collateralized debt, these are all quite popular, and they all fall under the private debt umbrella. I think to be a bit more, let's say, have a more of a like a framework and a structured approach to it, I think there are a couple of aspects you can look at which lead to these sort of categorizations. So the first, as I was mentioning, is the senior mezz, which essentially just means in the case of a repayment, who gets paid first, right? And I think some of our audience who might be familiar with the VC world might be familiar with the concept of preferred shares, right? Essentially means in a case of a liquidation, you get your payout before the ordinary shares. So that same concept exists in the world of credit as well. So if you're senior, that means you get paid out first, usually, and then you have a mezz, and then you have a junior. And then you just go down the waterfall in terms of the preference of getting paid out. Now, the second, I think, category would be the availability and the use of security. And security here meaning not like security in the form of a financial instrument, but like collateral. What is a specific thing with the value that is securing the loan and that is underwriting the loan? So depending on whether how senior you are and whether you have such a secured position, could be senior secured or senior unsecured, meaning you're first in line, but there's no specific asset that is underwriting or covering the loan that you're giving. You could be mezz, which is usually unsecured and behind senior. But of course, you can have a hybrid combination where you still have a security, but it's a different form of security from the senior lender. Or it's the same security, but you also sit behind the senior lender in terms of the preference, not just for the repayment of the loan, but the liquidation of that security as well. So that we would call like a first lien, second lien, depending on kind of, again, where you sit on the preference.
Okay, so like the world of private credit is pretty big. I mean, we're talking about corporates and all the way down to SMEs. Given the probably likelihood of our audience being more startup and venture capital focused, what is the type of products that could be applicable for startups? And most interestingly, if you've just raised a $100 million fund, which part of that are you looking to tackle? Because you're clearly with 100 million not going out and kind of giving lending lines to corporates, or you might be. So kind of what's the focus for you as Shorooq, and for VC-backed startups, what type of product would they be able to benefit from in the private credit world?
That's a great question. So, I mean, what we would classify as a venture debt doesn't refer specifically to a single type of a debt. Rather, for us, it's that classification falls to credit that is provided to startups and tech companies, right? So I think that's kind of, you first want to start looking at lenders and providers of credit who are even willing to look at that space, because a lot of established and traditional banks actually wouldn't come down the ladder that far, right? As you said, the world of credit is quite big. And depending on who your target is, which market you're in, you don't want to be wasting your time by trying to apply for a loan or a line of credit to someone who is not in that market, in that segment. So venture debt providers would typically have a technology background. So even if you might not necessarily be a VC, the people who are in the firm and in the team are composed of people who have had exposure to that, had a career as a VC in their previous lives, in their previous roles, is interested in looking at companies where they might not be as established, or let's say generating a stable recurring revenue, but you are backed by the IP, the technology, the idea, a new business model. And those are all things that you see and believe in the value of. So that's like a very fundamental, I think, a place to start with, but I think it is important. Now, as to kind of the more of a technical, let's say, the composition of venture debt, because like I said, venture debt doesn't really fall into that technical aspect of whether your preference or senior security. It comes in a variety of forms. So even when we look at our borrowers and we structure our deals, depending on the availability of the asset, the nature of that asset, the sector and the segment you're in, your previous, let's say, investors and the type of the capital you have raised. We've done senior secured loans, we've done unsecured loans, we've done mezzanine debt, we've done structured deals where the asset that is serving as a security are hard assets. It's a book of receivables, it's a book of loans. So there's a lot of different ways you can structure it. And I think it's one of the beauties of credit, because equity, again, because a lot of our audience probably has that VC or a founder background, you'll see that a lot of the equity rounds are pretty standard. There's a boilerplate template now. It's a tried and true kind of a form. You have a set number of clauses and aspects you're looking at. The terms, everyone has a drag along, the tag along, the anti-dilutions, preferred shares, conversions. Whereas credit, there's no one size fits all. And every deal you get to customize and structure. It's what makes it more complex and also more challenging. But I think it's also where the beauty of the product lies, that you can customize a deal specifically for a company according to the situation and the use that they are looking for.
But let's be clear, this is not really something that you're going to use for early stage startups, right? This is for potentially more mature companies. So anyone who's a startup here looking to do a seed round or an early stage investment round, this is no replacement for a company that's looking to get set up. I mean, is it generally more established companies?
Absolutely, and that's a great point. Because even though when we say venture debt, we are definitely looking at earlier stage companies than traditional banks. We also have a limit to what how far we can go down, and that's because credit, by definition, implies an obligation, right? Equity, you don't have any payments obligations. When the company does well, investors share in the upside. But if you're taking on a debt, even if the company does not do well, that obligation still stands, which is why we only look at companies who have already completed their Series A and are in beyond stages. So before that, we want the founders to actually raise their capital through equity, because credit isn't there to replace equity. It's more of a complement. It is very important to have that early group of early stage investors coming in through equity, coming through VC, who believe in your product and your business. And once you use that capital to grow and have a recurring revenue or a bottom line or positive cash flow, or in the case where absence of cash flow or assets, that's when I think it's the right time to start looking at credit.
And so great point. So here in the region, last year, if you look at the two most funded companies, they just so happen to be Tamara and Tabby, both of which are buy now, pay later companies that have both actually raised equity rounds and substantial private credit rounds to complement them. Without going into the details, and of course you're an investor in one of them, what's the logic behind that? What is the logic of going out there and using the collateral effectively from the equity round, and then potentially using an investment round that can come from a credit line, but with such huge amounts? I mean, we're talking about $200, $150 million worth of credit lines. What's the business logic of raising that amount of capital?
Gotcha. There, I just want to clarify something. You used the phrase collateralizing the equity rounds or the proceeds of the equity rounds. So that is not necessarily how we look at it. Of course, the financing coming in from equity round is the company's asset, but we wouldn't really look to kind of give out a loan based on the cash that is coming from equity. So that's just to get one thing I wanted to clarify. Now, to go back to your main question.
So that's okay. I'm gonna double click on you on that, because I think it's quite interesting. So I've always thought that in many cases, when you look at the size of the equity round, it seems to be somewhat a proportion of the amount that's being raised in debt. And so, welcome you to correct me, because I'm not the expert in that field, but it's always, in my opinion, felt that worst case scenario, you can't pay off the credit. Well, you've raised the collateral, you've raised an equity round that provides an element of a buffer, so that at least you're not going to go into default. Is that logic flawed, or is that what you're saying? It's not the logic by which you go and give the credit line, but it gives a safety net?
I think it's a great question. So it is definitely a factor in the sense that, of course, having that equity round does serve as a buffer, because if we again look in the kind of the waterfall, the creditors do sit above equity. So if a company has a large amount of equity or the ability to raise such equity capital, it does give us more comfort. Now, however, the reason we don't want to bank on that or give out a loan based on that is that really what should be underwriting the loan is the business case, right? The cash flow and the asset that's being generated by the business. The equity rounds provides a buffer for sure. And it is also, in a way, almost a proxy to the value of the company and how well the company is doing and what the market feels about the company. But in the end, there's a separate use for equity capital. So a lot of companies use equity for doing something that is more, let's say, riskier and innovative, that only the people who are willing to take on that equity stake and have that conviction in the company are willing to fund. So that could be your R&D, that could be your expansion into a new market that you haven't tried before. That could be expanding your product line into a more diverse array of products and services. Whereas credit, typically the use of that capital, it's earmarked for really financing things that you have already done and you know how to do. So a great example of that is working capital, right? Working capital is not sexy, it's not new, but every business has a need of it. And working capital arises from a business model that you're currently running and operating. So then what the creditor would do is, we can tell that you know how to run your business and that you know the ins and outs of this. What you're suffering from is essentially liquidity. And there, I think it's a great way for the credit providers to kind of provide that value add. CapEx, I think, is another one. Of course, not the first factory or the first building you're building, but if you've had that first factory, that first building, it's been running well, you want to use that, leverage that to build your second, third, fourth facility. That's, I think, again, a great use of capital for credit.
We're in a relatively high interest rate environment. The Fed rate is unlikely to come down in the next couple of quarters. I have been sharing how globally this has impacted the venture capital space. Regionally, depending on the geography, you're seeing a disparity on how venture capital has been flowing, but clearly cost of capital being higher puts a little bit more of a dampen influence on the venture capital asset class. Not particularly familiar, but I'm assuming if the cost of lending goes up, that the risk of lending goes up, but then maybe potentially a lot more lucrative for higher rates. Can you speak to the current environment that we're in terms of interest rates and as to whether it makes it more or less appealing, and then the challenges of default as a result of that?
Absolutely. But Philip, before we go to that one, I realized we didn't fully tackle the Tabby Tamara, kind of the example that you gave in the previous question. So let me actually just...
Sorry, I jumped in because of that.
I mean, it's an exciting topic, a lot of things to talk about. But just to double click on that, because I think it's an important one, and it's insightful, I think, comment to be made, which is that once you reach a certain scale, so once you've had those equity rounds from the early in your early stages of the company's journey, and you reach the scale like Tabby, like Tamara, then I think credit becomes very powerful because of its ability to scale. And what I mean by it, and this is something you pointed out as well, right? How can these startups, they're in the end, they're tech companies, raise these multi-$100 million credit lines? And I think the reason that is possible is that if you're looking at equity, what are you putting up to raise that equity capital? It's your cap table, right? It's your shareholding. And that's a finite resource. No matter how big the company is, you can only give away 100% of the company, right? So there's a limit to how much capital you can raise from the equity side. Credit, though, you're not giving anything up. What's happening behind the scenes is that there's a specific cash flow or an asset that's underwriting the loan. And as long as the company grows and that underlying cash flow of the business or the asset grows, then the loan can be scaled indefinitely to match the growth that you're achieving in your bottom line. And I think that's what makes credit so powerful once you reach that scale. So companies like Tabby and Tamara, they're market leaders in their respective countries and geographies. And now when you are able to process billions of dollars in volume, and you're generating the asset and the cash flow that is underlying that volume, then credit can be scaled quite quickly, which again becomes a cycle and gives these companies the ability to scale even further, which then again can be used to extend the credit line even further. So I think that ability to scale and be non-dilutive and not be restricted by the 100% shareholding is something that is a very powerful attribute.
On the assumption that you can make the revenue to kind of pay that off, right? Because it's not equity.
Of course.
I mean, we've been living in a venture. It's strange because you're saying this in a world where venture capital has been scale at all costs, so that you raise the next investment round. The traditional model of venture capital, which right now is being put into question, where there are less investment rounds that are coming, and therefore the access to liquidity is a lot harder. But clearly, in credit, you still need to pay that off. That's the whole form of a credit loan over Absolutely. A period of time. That needs to be, so you can't be doing that for loss-making companies, or at least companies that don't have the revenue to be able to kind of buffer the challenge of having to repay that loan at any given point in time. So I think that's an interesting dynamic as to why these larger companies are being able to do that. But to just kind of go back to that cost of capital and the interest rate environment, is it a positive or a negative, or is it a challenge in the market right now that interest rates are likely to stay higher for longer, and some predicting that it may not go down until 2025?
So I think overall it is positive to you as a lender, because as you said, it does allow you to have a higher yield in the investments you're making. But again, depends on which side you're standing, right? If you're a founder and you're someone looking to raise capital, your cost of capital has just risen. So it's not the best thing in the world. Now, having said that, I think even from the lender's perspective, it does call for a very cautious treating, right? Because, and to tie this back to what we were speaking about before, Philip, there is such a thing as too much credit. right? There's no such thing as too much equity from a founder and a company's perspective, right? The more equity money you have, the better. You're not holding to anything. But yes, credit, it is an obligation. And regardless of the performance of the company, you do need to pay it back. So in an environment like this, when the interest rate goes high, it's not just that the interest rate is going high, but also that the valuations are being suppressed. So despite the fact that the cost of capital is high, more and more founders are turning to credit, because if you go out into the market right now, you're getting a discount on the valuation you could have gotten, or perhaps even you need to go to the market at the down round to your previous round. So even if the cost of capital is 500 bips, 600 bips higher, we see people still going, which is leading to a larger and larger demand for credit. Now, again, if I have to put a finger on it, overall, I'd say this is a positive development for us. But it means that the amount of credit that is being given out in the market right now and the cost of servicing that credit is in a very high rate. So that is why I do urge the founders and also our audience, to do the proper diligence internally to see whether the company's in a stage and is at a capacity where they can take on credit. And once you do make that assessment, also how much that you can take, right? You don't want to be overly optimistic here. There's an obligation that you're going into. And I would actually extend this kind of, let's say, a cautious warning to lenders in the market overall as well, because I think it's times like this where we always see the market becoming frothy, and we want to guard against that.
So, I mean, on that, to be useful for the audience, can you give any guiding principles of the type of companies that are applicable for venture debt, private credit lines, what type of stage, what type of revenue, what type of loss or profit they need to be making? You don't need to be specific, but like general broad strokes that can help someone think about whether it's applicable for them as a founder.
Absolutely. So you'll see that I kept mentioning asset and cash flow as underwriting the loan. And I think in the end, it comes down to those two things. So we don't expect our borrowers to be making profit, meaning like net income positive. In the end, this is venture debt. Where we do want to see is either, do you have an asset, whether that's tangible or intangible, that could be used to underwrite the loan? Now, those tangible assets could be, if you're in like agri-tech or smart farm business, like the farms and the facilities, the PP&E. If you're in retail business, it could be your brick and mortar stores, the inventory, the physical products that you're carrying. If you're in the renewables and energy sector, it could be the power plants that you're looking at. But these assets could also be intangible, right? They don't have to be hard assets. And I think in the case of most startups, they will tend to be intangible. So those could be your receivables, your invoice. Trade financing is something we do as well, which is another established practice in the private credit world, but something I think that could be very easily lifted and applied to the world of startups and tech companies as well. Because logistics, I think, is a big sector here in the region. Now, the other side is cash flow. And cash flow, I think, is a less, let's say, a contractually guaranteed form of value, because now we're looking into the future, right? This isn't something that exists now. But if you're a SaaS business, you have a recurring revenue, your churn is low, your stickiness is high, and you have the track record to show that, then although this isn't what you would typically classify as an asset because it's non-existent now, we would kind of look at that cash flow and the quality of that cash flow to extend the loan. So I think those two are the main things you're looking for. Of course, if you're in that rare but a beautiful bucket where you are actually net income positive, always makes for a better kind of assessment and a conversation. But I think those two assets and cash flow is where you would normally start with. Now, the other thing that we actually...
Sorry.
Oh, sorry, go ahead.
No, go ahead.
The other thing I just wanted to mention quickly is something that is specific to Shorooq is we only look at companies that has a CFO for our credit investments. And I think this is very, very important because, again, I think this is a recurring thing. Because it's an obligation, there's a fixed payment. You need to pay interest. You need to amortize your loan. Let's say the sophistication and the amount of work that goes into servicing a loan is far, far higher than equity. And we feel much more comfortable when there's someone who's dedicated to managing the company's finances and liquidity, not just the business and the commercial. So that is something that we do screen for. And for those companies that don't have it, but is we feel like is ready to start taking on credit and is at this stage, we urge very strongly to look for a CFO before coming to the table.
I looked up before this, and I saw it's just a year and 2 months since the collapse of SVB in America, which caused shockwaves. They were the bank of choice of many venture-backed companies, but they were also one of the largest lenders of venture debt as an asset class in the US, and they were quite proud of providing credit lines. What are some of the risks of providers of credit and private credit in this space that maybe founders need to be aware of, that the due diligence is in both directions? It's not just on them, but also to look at some of the providers that are providing venture debt or credit as a tool for them.
That's a great question, Philip. And I think this is a very timely and a relevant question, because like I was saying, I do think the market is becoming a bit overheated. And especially in this sort of a rate environment, you want to be going to the best lenders and the people who know what they're doing for your facilities. So for the founders who are looking at the creditors, I think, let's say there are a couple of things to start out with. You want to make sure that they have the capital that you're asking for. The second, I think, an important aspect is that they understand the sector and the business model of the field that you're in, right? So this could apply to, in a general sense, that this is a lender who understands the tech world and the startup physiology of startups, right? Typically, if you look at these corporate kind of direct lending at the blue chip Fortune 500 companies, a lot of covenants in the loan documents. That is not something that would be very applicable to startups, right? It would hamper the business. So you also don't want to be looking for no covenants, because that probably indicates the lender isn't as aware of what they're doing. But what you're looking for is that balance of 2 or 3 key ones that really are relevant for the maintenance of the integrity of the loan and the facility, but isn't hindering or preventing you from doing your job from an operational or commercial perspective. It would also, the best kind of a creditor in the venture debt scene would also understand the equity dynamics, right? Because like I said, this is not a replacement, it's a complement. You want your lenders to be able to work with your equity investors and your board members. If the two are going against each other, that makes for a very tricky situation for you as a founder and a management. Also, you want these two to kind of, let's say, go hand in hand and make sure the raising of credit and equity facilities, that there's a timeline behind that, right? Because in an ideal world, you raise your credit facility in between the equity rounds so that you can grow and scale the business, so that by the time you get to your next equity round, you have grown and you've hit your KPIs and your milestones, that you can go to the market at a much higher valuation, right? And credit allows you to do that before raising the equity, before making you get into those valuation discussions with the investors. So that's net positive, because it's good for the founders. Of course, you get a higher valuation. It's good for the lenders, because like I was saying, equity money that comes in, it only strengthens the financial position of a company. So I think someone that understands the equity dynamics, the shareholder dynamics, understands the VC world is also something that is key.
And I want to demystify something, because I will never forget this. In the midst of the COVID pandemic, when everyone was sitting at home, there was a lot of excitement in the ecosystem here around venture debt. And many investors going out there and, without naming names, saying that this is a great opportunity, we should be developing this. But as a survival tool for companies in challenging times, with the logic being, if they are to default, well, it'll convert into equity anyway, so we can become shareholders at a discounted price. And I found it very confusing listening to people say that, because I was like, correct me if I'm wrong, but that's the complete wrong use of the tool. It's a worst case buffer to protect the investor, but it is not intended as a tool to support companies that are struggling for survival to get discounted equity rounds into the company. And I found that very opportunistic. Correct me if I'm wrong, but that's the type of bad behavior you'd be looking at if people were mentioning it.
No, you're absolutely right, Philip, right? Like that phrase that you said, right? That just shows how paradoxical that thinking is. Like if you're a struggling company, you should not be raising debt, right? It's almost an oxymoron. if you're in a struggling state, the worst thing you can do is raise debt, because it will actually cast a larger burden on you to whatever you're having to deal with right now. Because when you're in that struggling position as a startup, as a founder, what you need is a flexibility to shuffle things around, make sure that you're focusing on the right things, get the support from your board members, maybe perhaps even lower the salaries of your employees and yourself while you work that out. Make sure that you have that maximum cash buffer. All of this becomes restricted as soon as you have a creditor, right? Because the creditor in the end is protecting themselves. And I think this is a key difference in the mindset that I think is important to point out. And also to demystify, like that mindset of creditor is not coming from the fact that because we want to choke the company or we want to kill the company, but you need to think about the nature of the capital that is being provided. So if you are a credit provider, what you have promised your investors, right? Because fund managers like myself and the other VCs and GPs out there, we have raised capital based on a specific strategy. So then if you're raising a credit, the promise you have made is a downside protected capital. Meaning if push comes to shove, then your obligation as an investor is to make sure that your downside is protected and you protect the principal of the loan. Whereas if you're an equity investor, the promise that the manager and the VCs have made to the investors as well is, look, guys, this is a high risk, high return product. Like in the end, a lot of these companies might not do well, but we are in there to be partners to these companies. We're there to support them when it's not going well, because we believe in the upside. We have the conviction of the founder, of the business model, of the idea. So the approach itself is very radically different. And I think what's important and smart thing to do is not to approach or take those two different approaches in a personal, emotional way, but just look them in the eye, understand why people are sitting on different ends of the table, and make sure that you are partnering with the right capital provider at the right time. And this is why, as Shorooq as a firm, we have a very clean separation between our debt practice and equity practice. Something a lot of you who's in the call today might have heard of is that we call ourselves founders partners. And that is a tenet that we hold ourselves very strictly to for the equity practice, where there we help you grow the business. But again, this is a different kind of a mindset between the credit and the equity, and it's important to know which is which.
Great. So I see lots of questions, which I think is amazing, and I'll try and come to them in a second. Two or three final ones from my side before doing this. Number one, you've mentioned it, but I want to try and get into it in a bit more detail without going too long. A VC fund has an X multiple return that they need to provide to their investors, and their LP investors tend to be institutional or sovereign. Can you explain, without going into too unnecessary details or details that you're not comfortable sharing, what does it look like for a fund for credit? Is the return expectations completely different, I assume, to venture capital? And who are the traditional LPs of a fund that is credit focused as opposed to it potentially being venture capital focused?
So the return profiles are quite different. So in the credit, you're not looking for multiples, right? We benchmark our returns to percentages. So no one's looking for like 4 or 5x if you're investing in a credit fund. The typical, just to put some concrete numbers around it, I think in the Middle East as an emerging market, in this yield environment, what you're typically looking for is a mid-teens rate all in. Now, the flip side of that though is, although we're not looking for like very high aggressive returns, we're actually much more sensitive on the downside, right? So for VCs as a fund, I mean, this is quite well known. Like you expect the 60-70% of your companies to go bust or just do par. But it's really the 20-30% that does that spectacular return that returns the fund. On the credit, what you're looking for is you want to minimize the defaults, you want to minimize the busts, even if the really good ones don't end up doing 4 or 5x. And that's, I think, kind of the key difference in the mentality of how we approach the returns. Now, I think one kind of a more fine, let's say, fine point is that the way we also think about defaults are different, because in a VC world, if a company goes bust, it goes bust, because usually you're an equity holder, you're kind of sitting at the bottom of the capital stack. As a creditor, though, even if a company goes bust, of course, we don't want that to happen. But even if it does, it doesn't necessarily mean the value goes to zero, right? There's always something there. So it's important to work with creditors who know how to manage the process of recovery. Like if you defaulted and the investors throws you away. I think that's a horrible relationship. You want the creditor to work with the founders to get the maximum value that you can from what is remaining, and also make sure that process runs smoothly and that there's something left for the equity holders and the founders and the shareholders. So I think that's the return profile. The second thing you mentioned were how does the LP characteristics look different? Yeah. So that's an interesting one. And let me kind of put it into two different buckets. The really large, sophisticated LPs will do both because from a portfolio construction perspective, and yeah, I'm going back to like my Markowitz classes from college, but essentially modern portfolio theory teaches us that when there are assets of different risk return profile, the more options you have, the greater the total return frontier of a fund, of a portfolio tends to be. So if you're managing a billion plus and you're sophisticated enough to have teams that look at multiple asset classes, they will do both credit and equity. Again, the return expectations will be different. From your equity side, you're looking for that 4 or 5x. From your credit side, you're looking for the 20%, but with downside protection. But they will do both. Now, I think for the smaller investors, there is a divergence. And usually the people who do equity, they're what we call strategic investors, or they have an aspect of strategic investor mentality, meaning they're not just in it for the returns. They're actually in it because this is a sector that they're interested in. And these would be your corporates, right? You would see these large corporates having their own CVCs or investing into startups. Why do they do that despite they're 100 times larger? Because they want to kind of get to know the cutting edge technology, the business models in the field, and see if there's a collaboration that they can be achieved. So there's a lot of equity LPs, I think, have a strategic mandate. Now, the credit investors tend to be much more of a financial investor, meaning you're looking for fixed income, set yield, and cash flow. Because again, VC, this might sound paradoxical, because if you're looking for financial return, shouldn't you be in VC? But it's a much more uncertain return profile. And the second kind of a variable is the time. If you're in VC, it takes 10, 12 years for you to actually have cash in your hand. Exactly. In the meantime, these are all fair market values and unrealized gains. They're on the paper, but you don't have anything in your hand. Whereas credit, we're giving back regular coupons every month, every quarter.
Yeah, I think that's important. The regular coupons is an element. I mean, we just had an excellent conversation with Basil on secondaries and the need for liquidity, and exactly that. In the end, it's liquidity and how your ease of getting access to liquidity and in different investments. Final question before I kind of ask some of the other ones. Obviously, with MAGNiTT, we're continuing to develop the platform to capture this information, but one of our key client base is government, and this as an asset class is still relatively new in the venture space, let's say, rather than in the corporate space where there's a lot of financial institutions. Any advice for governments to embrace, encourage, develop private credit as a tool for startups and early stage investment that they need to be aware of, or any regulatory changes that can help enable that we should be aware of or share when we're having conversations?
So I will start by saying that it would be great to see more and more of these government entities and institutions embrace credit. Again, goes back to the modern portfolio theory. I would never say that only credit is good or that credit is better than equity. In the end, I think what is good for the market overall is that if there are a lot of options, right? So then each company, each founder, according to his or her needs at the time of the business and the stage of the business, can have the most efficient cost of capital. And I think that's in the end what we're trying to optimize for, if you're the CEO, if you're the CFO of a company. So there is a room and place for credit that equity can't really fill. And I think it's great to have a more available credit in the region to tech companies. So that's, I think, the general, let's say, the sentiment that I'll leave you with. As for more specific regulations, I've actually been very pleasantly surprised since I've come to the region to find that there are very robust credit and lender frameworks and regulations in the region. In a large part thanks to free zones like the AFC and ADGM, where your common law base, the jurisprudence is also benchmarked against English law. So the borrower's protection, lender's protection, ability to register and assign security, these are all quite advanced in the region. And I think it's something that I, as a creditor, have been very pleasantly surprised with. And it's definitely something that helps us do our job. So I'd say kudos to the regulators. And I love to see kind of this sort of a continued trend on the robustness of the framework.
Great, Nathan. Look, I'm going to ask a couple of questions from the audience. If we try to keep the responses brief, we'll try to get as many as possible. If I've misunderstood the question, then please feel free to kind of correct it. Somebody asked, what kind of securities and collaterals are commonly used in venture debt, if any, I assume?
Yes, so usually, again, depends on the facility and the structure, but we do prefer to take a security. And like I said, it's usually in the form of assets. So if it's a tangible, if you're in your industrial manufacturing, energy, renewables, smart farm, agri-tech, those will be your PP&E. If you're in your retail and a physical product sales, those will be your SKUs, your inventory. If you're in the fintech financing platform, trade, logistics world, it will be your receivables invoice. So perhaps the question is arising from the fact that how can you collateralize or take security over an intangible thing as a receivable? If you think about it, receivables and invoices are simply contracts, right? And contracts infer a right to be paid at a certain point. So that right is legally and financially valuable, and it is something that can be assigned or attributed to a lender. And for us, that becomes that value that's underlying the loan that we're providing.
Cool. What do you think about redeemable equity that can almost be similar to debt? Is it a bad signal for investors when a previous VC fund offered redeemable equity to a startup?
So not necessarily a bad thing. This is just kind of, I think, the trends in this age. You see a lot of these hybrid instruments, right? Convergence between credit, equity, between the different kind of the capital providers. So like I said, usually the more options you have, the better for you, because you get to pick something that is the most appropriate for you. What I would say as a word of caution is that if it's a redeemable equity, I think the characteristics make it much more akin to debt than equity. So treat it like that. But of course, if the terms are right for you, then there's no need to necessarily shy away from it.
There's been a few questions around SaaS startups, and you talked about, as a SaaS startup ourselves, the ARR, the growth of the ARR. The question is, do you have any examples of successful SaaS tech startups that have raised credit rounds, I assume globally or regionally? How did they do it, and did it prove to be fruitful? I don't know if you know how they did it, but can you speak to SaaS startups, how they would go about raising a round, and how successful that's been for the market in general?
So here, let me start off by saying this is the more unusual case, right? This is not the norm. We do prefer as a lender something that is contractually guaranteed cash flow, meaning it's receivables, it's an invoice, it's a service that has already been provided. Now, if it's a SaaS, it comes close to that, right? So, because although no one's forced to maintain a subscription, but usually if the product is good, the customer behavior will mandate that they continue to use it. So that's where I say that this is something that we do look at and we can look at. But as a norm, it is not a preferred method. And I don't think SaaS companies are the best for credit, to be honest. There are some specialty lenders who do something called revenue-based financing, where they specifically look for this sort of a model. Those might be a better, let's say, a fit. But again, if these sort of revenue-based financing has almost a debt equity hybrid structure, whereas you have a fixed obligation that you need to pay, but there's also, you're giving away some of the upside because this is the payment that you're making is based on the revenue. So there, what I would say is that if you are a really established SaaS company and their quality of revenue and cash flows are high, then I think it's definitely worth kind of having a conversation with a lender like us to get the better terms. But if you're growing quickly and you might not be having as quality of a cash flow or as many years of track record to show, but you believe in the product and you're seeing a good MRR, then it's worth talking to these RBF companies as well.
Two more questions, I think, that we can probably get in. One, interesting, do you provide local currency debt in MENA? And if not, how do you manage weakening exchange rates across the different geographies without naming specific countries? So I guess, interestingly, are you focused geographically, or is it pan-MENA, and how do you deal with exchange rate?
I feel like we have an investor in the crowd. It's not a question I expected. The short answer is we don't do local currency, so we only do USD. And from a geographical perspective, we lend to countries whose currencies are pegged to the USD or international basket of currencies. So we don't take on Forex risk.
So I'll give you two more questions because one's mine. Can you give an example of how you structured warrants into your venture debt agreements? What conditions do you use?
That's an interesting one. Let me kind of give the standard kind of structure that you would typically expect to see. So warrants are typically given at 10 to 20% of the loan facility size. And they're different from equity in the sense that these are options to buy shares in the future, right? So when the lender is providing the loan, they're not taking on the shareholding at the moment. It usually comes down the road. What you can typically expect to see is that there are two kind of dynamics at play here. One is, of course, from the lender's perspective, you want to increase your returns, and the warrants help you do that. And it compensates you for providing credit, which is usually only available to more established companies, to an early stage company that is tech-based and is not net income positive yet. So it kind of compensates for the additional risk we are taking by providing credit to an early stage company. Now, I think an interesting perspective, though, that is also beneficial for the founder's perspective is that once a lender has that warrant in its investment mix, then now you're actually vested in the company doing well on the upside as well. So I think it helps kind of bring in line the incentives between the lender and the borrower, which I think is quite important when you're looking at startups and tech companies, right? Because you don't want the lenders to behave as just lenders, and you want them to be someone who understands the business and works in the business. Sorry, works for the business.
Cool. Final question, because I'm fascinated by it. We recently heard the announcement that Shorooq Partners provided a loan or a credit line to Property Finder that actually bought out an early stage investment, Beco Capital, at least that was publicly shared. Is that something as well that you can use a credit line to buy back early stage investors, or is that something that hasn't quite been explained as part of the PR exercise? As to, is it just a cash injection that allows them to do growth or other operations? And that is one element of what they've also done. Can you speak to anything that was kind of shared with that recent news?
So I'm not too familiar with this deal myself, but I would imagine it was probably a buyout by the management, right? They bought out the shareholder.
Yes.
Yeah. So then this is a quite common practice, meaning if you want to take a company private, or I guess in this case, if you want to take a company back in the hands of the management and the founders, yes, essentially it's very similar to a leveraged buyout, where you purchase the shares upfront by using a credit facility, and then now that you own the company, the profits of the company come to you, right? So you use that revenue and that profit to pay off the debt down the road. So I don't think it's as prevalent in the startup world. This is more of what you expect to see in like barbarians at the gate type of a situation. But absolutely something possible. And I think as the region becomes more sophisticated, we'll see more and more of these sort of structured deals and transactions as well.
Nathan, thank you very much. Super insightful. As I said, this is an area that we're extremely excited about. I think that private capital as a whole asset class is becoming a lot more prevalent in the region. We've spent a lot of time talking about venture capital. We are excited to host a private equity webinar in the next couple of weeks. We've done secondaries, private capital, credit now. I think this is an area that's going to continue to grow in the years to come against the backdrop of what is a complicated macroeconomic environment and interest rate environment. So it's interesting to see the opportunities and the challenges that it provides. Congratulations on the new fund. I'm sure we'll be hearing a lot of news around different types of arrangements and transactions that you're going to be doing. But for now, I just thank you for your time, your insights, and I hope that was extremely useful for the audience, and look forward to catching up in coming months on your progress.
Thank you, Philip. It was very fun for me as well. Thank you for hosting, and also thank you for our audience who took the time to listen in. It's been a pleasure.
Thank you. Thank you very much, Nathan.